In market news now, the People's Bank of China exceeded market expectations for stimulus by cutting two key policy interest rates ahead of a GDP report showing that economic growth slowed in the last quarter to 4%. A real estate slump and partial COVID shutdowns are among the challenges for the world's second largest economy. Meanwhile, the Nikkei in Japan rose 0.7% and the Hong Kong shares also struggled as the Hang Seng Index declined 0.6%. In Europe, Credit Suisse became embroiled in yet another scandal as its chairman Antonio Osorio resigned after breaking coronavirus quarantine rules, and U.S. markets are closed today for Martin Luther King Day. But to talk to us about how a whole host of these events that are playing out globally are affecting our local markets, we are joined by Gary Boyson from Rand Swiss. Gary, thank you so much for your time. Given the fact that U.S. markets are closed today, you can imagine it's going to be a little bit of light trading. But that aside, how's our markets reacting to what's happening in Europe, but also with China and their GDP figures that came out early this morning?
Thanks. So looking at our market, our all-share index is up about 0.3%. And as you said, a very low volume because of the Martin Luther King Day public holiday. The resource index is flat, so not too much movement there. But we are seeing positive moves in the industrial. So the industrial index up 1.1%, financial index going the other way, down about 0.7%. So as you mentioned, Chinese GDP numbers coming out at 4% versus expectations of about 3.3%. So that's certainly, I think, starting to lift sentiment a little bit. We also got information about industrial output as well as retail sales. But the key number out of China this morning is that they are cutting interest rates for medium-term loans, and that's going to be supportive. And that's interesting because across the globe, we're dealing with a tightening market. And in China, they're actually adding stimulus. They're loosening monetary policy to try and increase growth. It hasn't had too much of an impact on the local currency, still trading around 15.40 to the US dollar, hovering above that key 21 Rand level to the British pound. And on the market, as we can see, we've seen some of the Rand hedges doing a little bit better. Some of the stocks that have exposure directly into that Chinese market, likes of Richemont, that up to around 2.5%. British American Tobacco also up over 2%. And as I said, really our financials falling. So the likes of Capitec down about 2.2 at the moment.
So on Friday, we had the U.S. banks kicking us off, publishing their financials, JP Morgan, Wells Fargo and Citi. And it's quite interesting to look at the amount of money that they're spending on modernization as well as wages. And tomorrow we'll have other banks also publishing their financials. What will you be looking out for when those numbers come out?
No, so whenever you look at bank earnings, they're always incredibly interesting because they give you a sense of what's going on in the underlying economy. Banks are just so crucial to every different sector. So it's a nice way to start the earnings season because it kind of tends to paint a picture for what's going to come. Now, unfortunately, both Citibank and JP Morgan actually missed their estimates. We saw revenue declining and earnings not coming in as high as analysts were forecasting. And really, as you mentioned, the key reason for this is actually wage price inflation. So they're having to pay the bankers more. But this isn't a situation that's isolated to the banking sector in the US. This is something that I think we're going to see throughout the economy as those wage prices start to increase. And that really does start to push up the inflation numbers. It's going to be interesting to see how the rest of the US companies deal with that. But looking at the banks specifically, they tend to be value plays. So it was interesting to see the miss on earnings really spooking markets and sending those share prices lower.
So when people talk about, the prospect of higher interest rates, it's generally the tech stocks that tend to suffer. Is that the case this time around? And is there a reason for one not to be exposed to tech shares?
No, so it's a good question. I think it's very early to tell. At the moment, we did see NASDAQ extending losses on Friday, and just before the close, it managed to finish positive. But when you look at a theme like inflation playing into the tech sector, this is generally a long-term trend. And some of the tech companies, especially overseas, not as many tech companies listed on the local exchange, but some of the overseas tech companies still very, very expensive. And I think it's dangerous to look at tech as a homogenous sector. There's some very, very reasonably priced high-priced technology companies, and there's some very, very expensive technology companies. Now, when you have higher inflation and when you have higher interest rates, the expensive technology companies tend to get hit. But the ones that are reasonably growing earnings and have solid products and are not particularly expensive tend to do very well. No matter where you are in the cycle, whether you're in a high inflation cycle where value tends to outperform growth, or you're in a very almost a trough in interest rates where growth tends to outperform value, there's no question that when you call it technology companies do tend to outperform the rest of the market because they are bringing new innovations to the globe. And when you have these new and innovative products, I mean, often they can grow even independently of the sector valuation. So I think it's important for viewers to understand it depends which tech companies you're looking at buying, and it depends the type of products that they're selling, and of course it's going to depend on their valuation as well.
All right, Gary, thank you so much for your time. I would have loved to have that conversation with you, talking about how one positions a portfolio given this kind of environment, but we'll save that question for a little bit later on, perhaps even next week as we continue to have those market analysis. We're going to take a quick break. When we come back, we'll have Africa Trade Brief with Nzinga, so stay tuned.